El Salvador, let's face it, it's on its back. They're grasping at straws with Bitcoin.
We don't really focus on the price, so it's not something we can comment on. It's really that the important piece that we care about is how many developers are getting into the ecosystem, how fast are they building their products.
There's a realization that this is a technology play, and no investor wants to miss the next internet. This is the next internet.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 8th of September. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Selling the fact legitimacy is Bitcoin's worst enemy, with the digital currency sliding as much as 17% after El Salvador makes its legal tender. Mike NOVOGRATZ tells Bloomberg he's still a bull. Too good to ignore. Well, DALIO says that opportunities in China and Singapore cannot be neglected as debate rages in the Chinese media over the meaning of common prosperity. And the great green mirage. Well, Bloomberg analysis finds that a quarter of U.S. sustainable credit lines since 2017 contain financial incentives that are largely meaningless. We'll discuss that with Chuka Umunna, JPMORGAN'S head of EMEA ESG. Now, first thing is first, as always, let's look at the markets. I woke up this morning and read a nice note by our Mark Cudmore from the MLife team that says, look, the problem with the market right now is that there's a lot of debate on exactly what we're seeing because of extra concerns about the Delta variant. And so you see half of investors saying, look, there's going to be some kind of market correction. The other half saying we're going to go ever higher. The European stocks taking a little bit of a breath of fresh air. You can see down some 1.1%. The focus, once again, is on China, the crackdown, what common prosperity means for some of the things that we're looking at, including industries, not only like tech, but also, for example, gaming. We're seeing a bit of downside also for the S&P futures, down some 0.3%. And look at oil, always a good idea when you look at economic forecasts. Europe, if you look at the UK, so a lot of financial and, of course, some of the big companies in the European map. I think we have it so that we look individually at the FTSE and what's happening in the CAC 40. I don't know if we can bring it up. Otherwise, I know a little bit of what's going on. You can see extra pressure, of course, on the CAC 40 and the DAX. Retail rich, very close to what's happening in the real economy. The UK, a bit financially heavy, was oversold yesterday. The UK story is also about extra taxation, and then Bitcoin has been, frankly, all over the place, certainly since yesterday. We were also speaking to Mark Mobius about that. Now, Bitcoin nursing losses after plunging amid El Salvador's troubled rollout of the largest cryptocurrency as legal tender. Now, the country's experiment with Bitcoin is seen by investors as the biggest test of the token's real-world usefulness. But despite Tuesday's sell-off, billionaire Mike NOVOGRATZ remains bullish on crypto.
It got long for good reasons, right? I think in the last 8 weeks, there has been a giant realization that crypto is not just Bitcoin being bought as a hedge against bad monetary and fiscal policy, but maybe more importantly, it's Web 3.0. It's the Internet of Value Transfer. There's a realization that this is a technology play, and no investor wants to miss the next internet. This is the next internet.
Let's now get back to our top story with Eddie van der Walt, and that's the markets. And within the markets, we fold Bitcoin. Eddie, thank you. So what exactly is going on with El Salvador? I thought they were actually going to support the cryptocurrency, but right. It's fallen out of bed.
Right. It was so much fun. Covering cryptocurrencies is never boring. And look, what we saw here was, this was going to be Bitcoin's coming out party in many ways, right? This was the first global central bank that country that adopted it as a reserve currency. So it was a big moment for Bitcoin, but it didn't go well, unfortunately. On the one hand, prices fell significantly. People were talking about pumping prices on the day, buying, $30 worth of Bitcoin. That we had this on Reddit and on Twitter. And then the price dropped significantly, as much as 17%. But then at the same time, there was glitches with the wallet. So it wasn't a great success, on the first day of this. Nevertheless, I think there will be some in the Bitcoin community that will be very happy to have seen this.
But it feels like a public disaster.
It feels like a disaster. On the one hand, on the day it feels like it. And today is certainly not a good day. There's going to be a lot of negative headlines. But people are talking about cryptocurrencies. People are saying, look, we have done this. There were people who made payments at McDonald's in El Salvador. And this has proven not a complete disaster for them. It has still been adopted. And you know what the president did? He went out and bought the dip. Another 150 Bitcoin he bought on the day. Unbelievable.
I mean, there you go, one of the biggest investors now in crypto. Eddie, when you look at what it means for, other, I guess, countries, but also central banks looking at this kind of thing, I mean, does it just go for, does it give water to the bears?
Ruud, look, I think it has highlighted a lot of the problems because in order to run a country's currency on it, you need to be able to put through a lot of transactions. And what we have seen historically for Bitcoin is when we're that high, when you see that high throughput of transactions, it becomes difficult. The network cannot cope. It cannot transact as, pass as many transactions through the system as can a Visa or, a MasterCard. So that's one difficulty. Another difficulty is in history, we've seen when exchanges get hacked, what happens is the wallet gets hacked, not Bitcoin. And this is something that will be worrying. And we've seen all of these problems potentially highlighted. No indication that El Salvador's wallet was hacked. But I think this will give food for thought. Nevertheless, Western central banks are working on their own digital currencies. So this is something that's still developing.
Eddie, thanks so much. Eddie van der Vaart there from our MLive team. Now, coming up, stocks and futures fall as investors assess multiplying risks to the recovery. We'll talk next with Michala Marcussen, the Chief Economist at Societe Generale. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's take a look at what's coming up today. Andrew Bailey, the Bank of England governor, speaks at the UK Parliament's Treasury Select Committee today. Then at 5 p.m. UK time, we also have the latest Russian CPI figures. A little bit later, all eyes on the Fed's beige book. And finally, we get GameStop earnings later in the evening, UK time. So here to talk about everything growth, recovery, and central banks is Societe Generale Chief Economist Michala Marcussen. Michala, thank you so much for joining us. There is quite a lot going on in terms of what we look at to try and figure out what GDP will be, what inflation will look like. Do you feel like economists are quite binary at the moment? There are the ones that are optimistic and actually the ones that aren't.
Well, I think it's true that when we look at the consensus, we do see quite a divide in views. But I also think that some of the division in views links to the underlying uncertainties that we still have from the pandemic. But let's just step away from some of the pandemic factors and consider what will shape the global economy moving forward. Now, to my mind, it was always to be expected that the reopening of economies would give rise to a fast restart. But beyond this restart, I see a number of frictions that are still there that we're trying to deal with. These frictions are visible in supply chains. They're also visible in companies trying to rehire. We do see a number of skills issues out there. And we also see some frictions in prices, which link to both those factors. And then I think there's a final friction that we need to consider, which is a shift away from the temporary support measures that we saw many governments putting in place towards some more permanent support for recovery, the sort of longer term infrastructure plans that are out there to support this is a longer recovery. And I think all of those frictions mean that the speed of the subsequent recovery is going to be slower. And then I think another point of division, so I think that's the first,
But when you talk about these frictions in supply chain and, for example, labor markets, right? I saw, you point to that as well. How can you be so sure that they're not structural changes that will actually, here to stay?
Well, I think we have to be quite humble on some of these issues because, indeed, if we just zoom in on the question of supply chain, I see a transitory dimension to it, so which I think will be resolved. But indeed, I don't think the memories of what happened in supply chains during this crisis are going to go away anytime soon. And then we also have the underlying challenges of addressing climate change. And I think companies will be rethinking the organization of their supply chains, probably giving priority to resilience, but also giving priority to some of these newer challenges with the climate change. On top of that, we're also seeing shifting consumer patterns, again, Part of this may be linked to the crisis and new ways of living. But again, climate change plays in. So I think that some of the changes we are seeing are indeed more structural. And indeed, as we move from one model, one economic model to another, inevitably there are frictions. So when it comes to the frictions, to my mind, some are cyclical. Perhaps if we look at things like used car prices in the US, I think that's a more transitory impact. But some, I think, are also going to prove longer lasting. And then I think
Michala,
there's another go ahead, sorry.
Yeah, I was going to ask you actually about spending. So it's very critical that businesses get back to spending and investing, and I guess the same for consumers around the world, but especially the American ones. I mean, how's that going so far? We had that very strange U.S. jobs report on Friday. Does it tell you to, surprises that we could get over the next 12 to 18 months?
Well, when we look at the U.S. jobs report, we do see a lot of the volatility coming from the hardest hit sectors. So I think we have to be cognizant that there may still be some transitory factors at work there. And then on top of that, we still have the questions of how the exceptional unemployment benefits may also have influenced individual decisions on the labor market. So I think it's going to be a few months yet before we get clarity. But coming back to your point on consumer spending, I think this is another point of divide for economists. Just how much of those excess savings will consumers ultimately spend? I take the view that some of this is, a good chunk of this is concentrated on higher income households and with lower marginal propensities to consume. So I would be less upbeat on this dimension. And it also links into the question of fiscal multipliers, which I think is another point of divide. Both a question on how quickly that fiscal policy support will be rolled out in terms of infrastructure spending and some of the other support measures in the pipeline, but also in terms of just how much confidence and how quickly that confidence can be built. Now, with all governments, many governments globally trying to run large fiscal stimulus, I think, again, there'll be frictions there.
I mean, we're seeing taxes rise in the UK. This is probably the #1 actually debate in all countries that have been through the pandemic, which is all around the world. Do you see the US going down the same route? Do you see, other European countries, and how does that change economic dynamics?
Well, so what we're seeing in the US, and this is already visible in the plans, is that the idea is very much to pay for some of Biden's spending plans through tax increases. So I think this is a thematic that's present. Now, if on paper we can design a very good fiscal program, higher taxes do not necessarily have to entail slower growth, depending on how the spending plans are rolled out. So I would be cautious on concluding upfront that it's a negative, but it's very important that it's managed in a favorable way, so that it doesn't become a headwind to economic growth. So to the extent that taxes are helping to create level playing fields, that they're being used to favor climate transitions, digital transitions, helping to raise educational outcomes, I think there can be a favorable argument as well. But again, we need to see, as you say in the UK, the proof will be in the pudding. So we need to see very carefully how these things evolve. But again, my bottom line here is that after a fast restart, I see recovery, but I am at the slower end of the consensus because of these various frictions we've talked about.
Yeah, talk to me a little bit about China. We're kind of running out of time, but what kind of proof in the pudding will we see in China? What are you expecting from authorities? Is it going to be more crackdown, or is it actually going to be a balanced crackdown to make sure that there's also not revolt in the street?
So what we see in China today, to my mind, is really a strong focus on making sure that the Chinese economic model can be sustainable long term. And this theme of very high leverage is one that the Chinese authorities have been trying to address for some time now. And I think as we move ahead, this is really the critical factor to watch. is whether this balancing act towards a more sustainable economic development model can indeed be pursued while ensuring still reasonably good economic growth numbers. So this, to my mind, is really where the critical aspect lies. It's in shifting the growth model towards balancing, and we saw this very much in the 5-year plan, balancing the dual circulation, as it's called, between the domestic growth drivers and still ensuring that the benefits of international capital flows and trade are there for the Chinese economy.
Michala, thank you so much. Michala Marcussen, their Group Chief Economist at Societe Generale. Now coming up, Morgan Stanley downgrades its outlook for U.S. equities after months of outperformance. We'll dive into today's market moves next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Boris Johnson's government will hold a House of Commons vote on its new tax package today. The UK's Prime Minister appeared to see off a Conservative Party rebellion over the tax hike after announcing that pensioners and shareholders would also pay more. The increases are expected to generate £36 billion over the next 3 years to fund the COVID-hit National Health Service and social care for older people. Now, the White House says 3/4 of U.S. adults have now received at least one dose of a COVID-19 vaccine as President Biden prepares to outline a new study to fight the pandemic. Biden will unveil the plan on Thursday, with vaccine hesitancy slowing the country's inoculation efforts and cases hitting a new record last month. Egypt's Minister for International Cooperation has described expectations for the country's growth rate as impressive. Rania AL-MASHAT spoke to Bloomberg at the start of the Egypt International Cooperation Forum conference, which is happening in Cairo.
Our growth rate has been one of the positive ones globally. Expectations are quite impressive going forward, and that comes on the back of very important reforms as well as projects across different sectors that have not stopped despite the pandemic.
And Mexico's top court has decriminalized abortion, loosening limits in a region where few countries offer access without restrictions. The Supreme Court unanimously declared that criminalizing early-term abortion is unconstitutional. The ruling sees Mexico follow Argentina, where elective abortion was declared illegal late last year. And that was your First Word News. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. We'll talk a lot more, of course, about these top stories throughout the day. Now let's get straight to your market update with Ritika Gupta. Ritika, how's today's trade shaping up?
Yeah, Francine, it seems to be a down day over here in Europe, and we can see that picture kind of shaping up in the US too. S&P futures down some 0.4%, and the NASDAQ also down. I mean, they've reached a fresh record high yesterday on some of those big mega cap tech names, but not escaping the pain today. Then I had to talk about yields here. We sit at 134 on the 10-year, so yields just a touch lower, but we have had a lot of chatter about why we're seeing higher yields after that disappointing payrolls data. Well, some people pointing the fact that we do have a deluge of supply coming to the market this week. Those Treasury auctions, $120 billion worth, and we do have that 10-year auction kicking off today. And then, of course, we have to talk about Bitcoin, because extending those losses down some 5% today after 17% drop yesterday after El Salvador really fumbling that exposure of a legal tender here for Bitcoin. Let's flip up the board here and let's talk about some of your movers on the day. Let's start off with Sanofi. That moving down 1.7%. They continue on that M&A spree. They're buying Canove Holdings here. This is a company to give them exposure to some immune system drugs. This is its third major acquisition this year, but a lot of analysts saying it's somewhat unexpected. So we see those shares ticking lower. And then let's stick with M&A here, but move it over to Morrison's. Those shares up just 0.5% here. They say that we will now have an auction between their bidders, Fortress and CD&R. They haven't given their final bids yet, so we see those shares, which have rallied over the past few weeks in this frenzy of a takeover, now up some 0.5%. And then also, I've got to look at Ferragamo here, a nice boost to the luxury sector. Those earnings, a big beat here, that net income coming in about 33 million euros. That is more than double what the expectations were. So a nice boost to luxury today, Francine.
Ritika, thank you so much. Ritika Gupta there with some of your main movers. Coming up, we discuss green finance and much more with Chuka Umunna, the former UK Shadow Business Secretary, now head of EMEA ESG at JPMorgan, joins us next. And if you have any questions for him, IB plus TV Go. You can also tweet me at Lacqua. This is Bloomberg. Selling the fact that legitimacy is Bitcoin's worst enemy, with digital currency sliding as much as 17% after El Salvador makes it legal tender. Mike NOVOGRATZ tells Bloomberg he's still a bull. Too good to ignore, Ray Dalio says that opportunities in China and Singapore cannot be neglected as debate rages in the Chinese media over the meaning of common prosperity. And the great green mirage. Bloomberg analysis finds that a quarter of U.S. sustainable credit lines since 2017 contain financial incentives that are largely meaningless. We'll discuss all of that with Chuka Umunna, JPMorgan's head of EMEA ESG. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance early edition on this Wednesday, the 8th of September. Now, first of all, let's hear from the Bridgewater founder, Ray Dalio. He was speaking at Bloomberg's Radar event in Beijing's regulatory clampdowns and President Xi Jinping's drive for common prosperity. Now, Dalio agrees that the push is necessary for wealth redistribution to happen. This is coming amid a brewing debate among Wall Street investors about the long-term viability of investing in China.
One way or another, we have to move more to an environment of equal opportunity, hopefully to produce greater productivity through equal opportunity, but also to reduce that wealth gap.
You set up a family office here in Singapore. What's top of mind for your family office here? What are the priorities?
Well, first of all, Singapore, the region, China, the whole region is a very, very exciting place. I won't get into all the reasons it's exciting, but it's a well-educated, civil, can-do society that takes care of its family finances well, and it's an exciting part of the world. It's a part of the world that one can't neglect, and not only because of the opportunities it provides, but you lose the excitement if you're not there. And so our objective is to be there both economically and investment-wise. I've been going to Singapore for nearly 30 years in terms of relationships and business things and so on, and I've become very, very attached to it. I love the place. And I've been going to China for nearly as long. And so it's natural that we should be there, and we will. I'm in the investment business. My family invests. And then in addition to that, we do philanthropy. And so we will do what we do there as well as in the States.
You know, Ray, for investors, it's always about return on investment. Trillions of dollars have been spent on major social problems like poverty, clean water, access to education. How do you evaluate impact from your giving?
Yeah, it's there's the saying that it's more difficult to give money away than it is to earn it. And that's right, because one of the challenges is the feedback loop coming from measurement. Dollars in versus dollars out makes profitability, and you live and die by that, and that is all good. When you're dealing with a bottom line that doesn't have such measurement, it becomes much more confusing. Even when I started out with philanthropy, I started to think, where am I going to get the greatest return on investment? And I realized that I was making apples and oranges comparisons. Things like, what does helping nature be better versus reducing a disease versus saving a life? How do you compare those things? You can't.
Well, that was billionaire investor and Bridgewater Associates founder Ray Dalio. Now, Deutsche Bank is calling the end of the honeymoon phase for remote work in a report to clients. The German lender has said that a growing number of workers report feeling isolated from colleagues. Well, it says that staff are also increasingly likely to develop physical problems due to inadequate work-from-home setups. Well, joining us now is Bloomberg's Wall Street reporter, Sonali Basak, on the very latest on this report. So, Sonali, Deutsche Bank coming out with this report, I mean, it doesn't, really, set fire to the world because a lot of us have been feeling it. What does it mean for the return to work for a lot of the big corporations?
Yeah, it's very interesting because Deutsche Bank itself is one of the firms in the U.S., at least, that has been more flexible than some of its other Wall Street peers. They say this about remote work, but equally you see a lot of companies that have been pushing their work into 2022 for coming back into the office for their employees, big tech companies, and there's still been a really large demand for flexibility from employers, that option to work from the office a couple times a week, but not every day per se, especially as so many families are still dealing with child care issues as their children return back to school in the U.S. So it's a mixed bag, but there is truth to the idea that there is a feeling of isolation. For the younger folks especially, what training do you get? What face time in front of your boss do you get? And what camaraderie do you get in the office as you are going through a very tough time in your career?
Sonali, is it a myth that actually people will change jobs because they don't have enough flexibility of working from home? I know we have stories, some people really care about it, but how difficult is it to get a full picture of what the majority of employees want?
It's not a myth. The reason I know it's not a myth is because from the investment bank executives I speak to regularly, they say that they are dealing with fairly elevated levels of attrition at many of the firms we cover. People just don't want to go back to the way things used to be. So what you have is a series of executives who are saying, okay, what does the future of work mean? How can we give people this flexibility? When, let's face it, Fran, these folks are not now working 5 days a week, many hours. They're working 7 days a week around the clock. So the amount of work that they have has certainly risen while they're facing slimmer desks and worries about what the future looks like in terms of whether their businesses will be competitive or not.
I mean, a lot of people, and we're seeing, a big staff turnaround amongst all of the Wall Street banks. Is it just because, during the first 12 months of the pandemic, people didn't move and so there's pent up demand, or is it because people are reevaluating their life choice balances?
There's definitely a bit of both. When people had moved from earlier this year, we had heard a lot of, well, COVID made me rethink my life choices. We've been hearing all year from recruiters saying that September, October is going to be a big time for attrition because all of these companies have telegraphed that September and October would be the time that they required people back. So we know that around this time we may see many more departures because people will be looking for employers with a greater sense of flexibility. It's starting to shake out which employers those truly are. You look at the screen right now and there's such a huge divergence. Take Morgan Stanley, which on one hand you have James Gorman who said if you're not back by Labor Day, he'd be somewhat disappointed. But we know that Morgan Stanley's offices in Times Square, the big building that everyone remembers, is about 50% filled in any given week.
Sonali, thank you so much for all that great reporting. Sonali Basak there, our Wall Street reporter. Now, coming up, we discuss green finance and much more with Chuka Umunna, the former UK Shadow Business Secretary, now head of EMEA ESG at JPMorgan, joins us next. If you have any questions for him, IB plus TV Go. This is Bloomberg. economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Credit Suisse has named Rafael Lopez Lorenzo as Chief Compliance Officer, filling the last gap left by the exit of Laura Warner after the Greensill and Archegos scandals. Lopez Lorenzo, who is currently head of the group's internal audit, will take over next month as the bank works to rebuild its management ranks. Christine Graf is appointed as the head of human resources. Ford has snatched the head of Apple's car project. Doug Field joins a 118-year-old car maker as Chief Advanced Technology and Embedded Systems Officer. Field also previously worked as a top engineer at Tesla between two stints at Apple and played a major role in launching the Model 3. And El Salvador's experiment using Bitcoin as legal tender had a rocky start as the coin's price crashed on its very first day. The cryptocurrency plunged as much as 17% to its lowest level in a month amid news that the government disconnected its Bitcoin wallet to fix glitches. Later in the day, the president tweeted the problems had been fixed. And that's your Bloomberg Business Flash. Francine.
I mean, I can't believe, I feel like half of my kids' friends actually at 10 years old are now talking about Bitcoin. I don't know if it's in a bubble, but it certainly feels like a bubble.
Imagine that, isn't it, Francine? When I was a child at school, we never had Bitcoin to think about, did we? We just had a little bit of pocket money that we were given to us by our parents. But what a day yesterday, isn't it? The first country to really make this legal tender. Let's see what happens.
I know, I was just skipping on a rope when I was 10 years old. Now half of them want to become hackers and the other 10 want to be fully invested in Bitcoin. Leanne, we'll have to talk a lot more about the habits of the youth. Now, onto our big take, and as corporate America grapples with growing scrutiny of its ESG efforts, firms are increasingly turning to Wall Street to help burnish their credentials. Yet critics say more and more companies are presenting overly polished images of both their commitments and their results. Now, a Bloomberg analysis of sustainability-linked revolving credit lines and term loans arranged in the U.S. since 2018 shows that more than a quarter contain no penalty for falling short of ESG goals. Now, that's only a minuscule discount if targets are met. Well, joining us now for more on this is Bloomberg's Tasneem Broger, who covers sustainable finance. So, Tasneem, I mean, this is actually quite concerning. Bloomberg analyzed some of these loans in the U.S. What were the findings?
Yeah, I mean, the findings show that with these sustainability-linked bonds and sustainability-linked loans, that essentially a lot of the targets that have been set are being set very low. So the issuers don't really face much of a challenge, and that the whole thing is sort of within its own sort of self-perpetuating ecosystem, whereby we're not sort of really facing a sort of a moment of tension when these triggers finally do kick in at some point.
So, Tasneem, what's the difference between a sustainability-linked loan and a green bond? So this is part of the kind of, the proliferation of all these sort of ESG labeled products. Green bonds are where there's a specific use of proceeds, where the issuer is telling the investor that, you're giving me this money, I'm specifically going to put it toward this project, which is climate friendly. With a sustainability linked bond or a sustainability linked loan, there is an element of something sort of environmentally friendly, or it couldn't be socially friendly as well. A lot of these targets are linked to sort of getting enough women in corporate boards and so forth. And that whatever those specific targets are that the company has agreed in its prospectus, that is what then has to be lived up to. If it doesn't, then that releases a trigger that then either sort of sets the borrowing cost higher or lower, depending on the extent to which they meet that target. Tasneem, thank you so much. Bloomberg's Tasneem Broger there. Remember, you can read today's big take, and I urge everyone to read it. It's a great read and an important one. You can read it on Bloomberg.com or also by typing NI Big Take Go on your Bloomberg terminal. Now let's continue our ESG conversation. Joining us now is the head of EMEA, ESG of JPMorgan, Chuka Umunna. Now, Chuka joined the U.S. Bank in April after a stint as head of ESG consultancy at PR firm Edelman UK. Now, before then, he was also a member of Parliament for Streatham in South London. He served as a UK shadow business secretary between 2011 and 2015 under former Labour leader Ed Miliband. Well, Chuka joins us as part of JPMorgan's High Yield Conference. Chuka, as always, thank you so much and welcome to Bloomberg TV. Now, over the last 2 to 3 weeks, there hasn't been great news on banks, on finance, and sustainability. And this all started with the whistleblower, actually, at the Deutsche Bank asset management company that said it's just not the right way to report things, that things are actually, bloated to make companies look better. What kind of scrutiny are asset managers now looking to see what they have in their books?
Well, thanks for having me on the programme this morning. I think in many respects, the reports and the debate around the extent to which ESG investing actually delivers positive outcomes, not only financial returns, is a sign of a maturing market. Of course, it's important that the products do what they say on the tin, which is why I think the European Union deserves quite a lot of credit for seeking to better regulate this space with the coming into force of the Sustainable Finance Disclosure Regulation this year, and there'll be further obligations falling on corporates from 2023 onwards. That is needed to give investors confidence that when they think they are investing in a product which is going to deliver a green outcome, that it matches with the description.
So, Chuka, we're now seeing probes, actually, at various asset managers. What are the wider implications for companies like JPMorgan?
Well, I think, obviously, across our franchise, we have JPMorgan Asset Management on the buy side, and I work in the sell side myself in the investment banking division, leading globally with a colleague in New York, the ESG advisory function. It's very important, and we advise our clients on this, that if you are marketing yourself as ESG and you are purporting to fulfill certain rhetoric, it needs to be matched with data and metrics to illustrate that you are doing what you're doing. Otherwise, you stand accused of greenwashing, and there's more and more scrutiny of this right now. Investors are being much more demanding as well about what it is that they expect from corporates. So, for example, this time last year, it was very much in vogue to have a net zero by 2050 commitment on the part of many corporate issuers. Now, I think investors are demanding a lot more. They don't just want a long-term target like that. They want an intermediate target around 2030. They want a roadmap to show how you're going to get there. They want science-based targets, and they actually want the CEO now, their compensation metrics, to be linked to delivery against that roadmap, instead of a situation where you say got CEOs committing their successors to deliver things when they may not be around. So investors are actually being a lot more demanding here.
Yeah, what does it mean for financial firms? So is there a lot more anxiety, given the probes, on being caught greenwashing than there was just 2 months ago?
I think you have to have robust governance processes and a framework within which you determine whether something is ESG or not, particularly as regulation is running to catch up with the evolution in this market. Obviously there has, ESG investing has been around for some time, but it's really gone mainstream over the last 18 to 24 months. And the regulators are running to catch up with that. And the EU, I think, is in many respects setting the standard. The US administration, you've got the SEC chair, new SEC chair, Gary Gensler, consulting on mandatory ESG disclosures. But make no bones about this, Francine. I think one of the refreshing things coming out of this, hopefully, beginning to come out of the current crisis with COVID-19 is, if you look at the last crisis, the global financial crash, the financial services sector and its different components was seen as very much the problem. I think looking ahead to the ongoing climate catastrophe that needs to be dealt with, I think finance absolutely is seen as part of the solution, because we're not going to be able to reach net zero unless we green our economies, and that's going to require a lot of money. And of course, the public sector is going to have fiscal debt and deficit overhangs from the cost of dealing with COVID. So the market, the private sector is going to be looked to fill the hole.
As long as the financial sector, of course, does what it says on the tin. So I think and our wonderful reporter Tasneem reminded me of this, between 2018 and 2020, I think Europe had to take away, ESG labels off $2 trillion in assets. Do you see a similar adjustment that will happen in the US and Asia?
Well, I think watch this space. I wouldn't be surprised if we see things like that happening in other regional centres as the market matures. But I think ultimately there will be more discipline, not least because the regulations require it. And this is really important, because if investors don't have the confidence of the integrity in the market, you're not going to get the capital allocation that is required. And, over the next 30 years, the estimates of the funding need to green our economies is anything between $100 to $150 trillion. You're not going to get investors helping with that unless they've got confidence that the money is going to be deployed in the way that they believe it will be. And that's fundamentally important. And, you know, at JP Morgan, we absolutely intend to play our role. We've committed to financing or facilitating finance to the tune of $2.5 trillion over the next 10 years to help deliver against the UN Sustainable Development Goals and to help with the climate transition, because we see that as an institution, it's fundamentally important to us making that contribution to society, but it's good for our shareholders too, because if you don't look after the environment, your communities, your people, your customers and clients, then you ultimately can't deliver good shareholder value.
Chuka, thank you so much. Chuka Umunna there, JP Morgan's head of EMEA ESG. Now, coming up, British Prime Minister Boris Johnson announces a new levy for health and social care, breaking an election pledge not to raise taxes. More on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, here in the UK, the Prime Minister Boris Johnson says that a new tax levy is needed to help fund the country's National Health Service and reform social care, despite breaking a key election pledge in the process. Let's get straight to Dave Merritt from Bloomberg News, who joins us now. So, David, I mean, how problematic, first of all, is it that the Prime Minister will be able to, to basically keep a handle on his Conservative MPs, given Conservatives usually cut taxes and don't raise them?
That's right. Well, earlier this week, there was a lot of noise that Mr. Johnson would be facing a substantial rebellion over this question, a broken manifesto promise, this idea of raising taxes across the board, really going against a lot of things that many people in the Tory party believe. But it turns out, actually, it's hard to see this as anything but a bit of a victory. That rebellion isn't really manifesting, and it seems to be fizzling out. He's going to get this through Parliament. And while there are some voices in his party who are still objecting, many people are actually falling into line. And it's because, of course, everyone realises that there needs to be some more money found from somewhere. And his line yesterday, that whilst not raising taxes was in his manifesto, COVID was not in anybody's manifesto. That seems to have worked. People know that it's been an extraordinary couple of years with extraordinary spending required, and now somebody's got the foot the button. And in fact, it is quite a conservative approach to try to mend the public services, and Britain is really out there in front of all the other major economies in the world in starting to rein in the stimulus and increase taxes to pay for some of the extraordinary spending over the pandemic.
David, thanks so much. David Merritt there, in charge, of course, of our overall coverage at Bloomberg News. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kailey Leinz will be in New York. We'll look at market moves. We'll, of course, look at Bitcoin. One of the other things that we need to talk about is the Fed Beige Book. We talk inflation, Bitcoin, cryptocurrency, El Salvador. All of that coming up. This is Bloomberg.
El Salvador, let's face it, it's on its back. They're grasping at straws with Bitcoin.
We don't really focus on the price, so it's not something we can comment on. It's really that the important piece that we care about is how many developers are getting into the ecosystem, how fast are they building their products.
There's a realization that this is a technology play, and no investor wants to miss the next internet. This is the next internet.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, September 8th. Our top stories today. Bitcoin's botched debut. The cryptocurrency sinks after El Salvador's troubled rollout of the digital coin as legal tender. Ray Dalio says don't miss out on China. The billionaire founder of Bridgewater Associates says there are too many opportunities here for investors to ignore it. And Deutsche Bank says it's clear that there are too many downsides to working from home. There is quite a lot going on in the markets, Kailey. A little bit of a down day as once again investors trying to assess what kind of economic risks they can see. And we have some really great stories talking about the debate and divide amongst economists and investors.
Yeah, we all have to figure out what exactly the Delta variant means in terms of economic growth, Francine. And it did seem Delta variant fears did weigh on the Asian session. Asian stocks actually lower for the first day in 9, snapping an 8-day winning streak for the MSCI Asia Pacific Index. Now, there were exceptions to the down day. Japan still higher by about 0.9% when it comes to the Nikkei. You still have a lot of optimism about a new prime minister bringing more fiscal stimulus, but they were down in South Korea, Taiwan, Hong Kong, and in China. And of course, one individual story that has caught everyone's attention is China Evergrande. The world's most indebted property developer got its second downgrade in 2 days, this one from Fitch on a probable default. So its bonds, its dollar bonds are right around record lows. And actually, the equity dropped below its IPO price from 2009 at one point in the session, but did manage to end the day higher by the better part of 4%. In the bond market in both Australia and New Zealand, you are continuing to see selling. The New Zealand 10-year yield sitting at right around 2.02%, which is the highest since April of 2019. And in foreign exchange, the South Korean won is the big underperformer. It's weaker against the dollar by about 0.75%. Now, here in the U.S., you did see cyclicals leading a decline yesterday. Big tech proved a bit more resilient, but futures are lower across the board this morning. We're down about 0.3% on S&P E-minis. You are not seeing what we saw yesterday in the bond market, though. That was selling and a steeper curve. Today, though, a bid coming in. We're down about 2.5 basis points on the 10-year to just shy of 135. Oil is trying to snap a 2-day losing streak. WTI is higher by about 0.3%, trading at $68.54 a barrel. And then, of course, Bitcoin, a really ugly day yesterday. Matt fell as much as 17%. Ended the day about 10% lower, but we're down another 2% or so because El Salvador did not go that smoothly yesterday, Matt.
It would be interesting to know the reason why Bitcoin fell. I don't think anyone's offered an explanation that I can get my head round, but I'll continue to watch for it. It looks like maybe it's the end of the everything rally, at least from this map. Take a look at European stocks, just down across the board. And of course, as you just saw there with Kailey, we're not looking for a positive open in the U.S. either. And investors are fleeing to the perceived safety of the bond market. So we see bond yields across the board going down, not just the U.S. yields, but also the Bund yields are coming back down again. Gilt yields are coming back down again. French and Italian yields are falling right now. So even though the arrow is green here, we do that for some unknown reason. It's actually down for the yields. The euro and the pound also losing ground against the dollar as the greenback gains. So 118.26 and 137.67 are your levels, Francine. It really looks like a little bit of a turnaround on this Wednesday. It looks like investors are definitely risk off. And the question is why? What's happened?
Yeah, the question is why, what's happened. I was looking actually at some of the notes, so I hear more and more, Matt, talk about valuation, then Morgan Stanley cutting that U.S. stock to underweight and also global equities to equal weight, actually citing some concerns about growth through October. Now, a look at what else we're watching today. And the UK Parliament will vote on the government's new tax package. This is after several previously sceptical members of Parliament welcomed the plan. Then the Bank of England Governor Bailey testifies on financial stability at 11 a.m. New York time. Deutsche Bank's Christian Saving and Santander's Anna Butin speak at the Handelsblatt Banking Summit. The conference runs until September 10th, and GameStop will report its second quarter results after the bell. Then 2 p.m. New York time, the U.S. Federal Reserve releases its beige book, and investors will look for anecdotal information on the U.S. economy. Now, Bitcoin's debut as legal tender is off to a rocky start. The cryptocurrency dropped to the lowest in a month after the rollout in El Salvador. Let's get straight to Justina Lee with the very latest. Justina, so we thought this was the big moment for Bitcoin actually to come out in the open. It's legitimate, it's legal tender, and actually it was really choppy in terms of trading.
Yeah, I mean, that's right. I mean, we often see this kind of pattern with cryptocurrencies, you know, buy the rumor, sell the news. And there also appears to be some glitches with the rollout yesterday. Like the government had to briefly disconnect the official Bitcoin wallet in order to fix those issues. And they do appear to be kind of resolved by now, but it really have kind of like made people quite nervous, you know, all across the crypto community.
Yeah, and we saw other crypto prices fall. I think that was interesting as well, Justina. it's not just about Bitcoin, right? Everything fell, and I just can't see a reason why.
Yeah, I mean, we often see this pattern with cryptocurrencies. You know, the volatility usually comes from Bitcoin, and a lot of the, the altcoins and even the NFTs all have very high correlation, which just shows you how the entire ecosystem is still very sensitive to like the sentiment of Bitcoin and kind of like these series of liquidations that often just kind of like roll across the system.
Absolutely. Bloomberg's Justina Lee, thank you so much. And now we turn to Washington. President Biden's $4 trillion economic agenda hitting more hurdles in Congress. Deepening divisions in the Democratic Party include objections by key Senator Joe Manchin that threaten its chances of passing anytime soon. Emily Wilkins, Bloomberg government reporter, joins us now from Washington. So, Emily, Axios reporting this morning that Manchin will agree to $1.5 trillion at most of that socially oriented spending. That is a $2 trillion goal from what has been proposed. Is it realistic?
So I think at this point, negotiations are still very much going on within the Democratic Party. You're seeing lawmakers begin to really put together these bills and to come out with the exact details of what's in them, and then those are going to be up for debate as well. Look, we knew that Senator Joe Manchin was wary of that $3.5 trillion price tag, and we knew that he was not alone. So sort of from the beginning, we had a sense that this package might wind up being a little bit smaller. The question, of course, is how much smaller? And perhaps the bigger question is which priorities are in or out. I mean, you have to remember, even though Manchin might want a smaller package, things such as child care, such as elder care, such as expanding Medicare to cover dental and vision and hearing, these are things that are popular even in more moderate Democratic districts. And at the end of the day, all Democrats, not just President Biden, not just the progressives, but even moderates, do want to see some sort of package pass, something they can run on in the upcoming 2022 elections.
I mean, you stole the question. I mean, that's, the million-dollar question is actually how much smaller can it be? And the other issue is we're hearing some Democrats could be eyeing taxes on stock buybacks.
Absolutely, and I think we're going to be seeing more details come out in the coming days. I mean, the White House has said that they are in contact with Senator Manchin, with other Democrats. I mean, these are positions that have been staked out for quite some time now among congressional Democrats. The only difference is that now the rubber's finally meeting the road. We're finally seeing some details emerge, and they're on a crunch. It is now September, and if they want to get it done, their deadline, they have a soft deadline of September 27th to really pull this together, and that does not give them much time.
19 days to be exact. Bloomberg's Emily Wilkins of Bloomberg Government, thank you so much. And turning now to Wall Street, Deutsche Bank is calling the end of the honeymoon phase for employees' relationship with remote work, citing in a report to clients that a growing number of workers are feeling isolated from colleagues. Sonali Basak, Bloomberg Wall Street reporter, joins us now for more. So, Sonali, that may be true, but a lot of banks still aren't bringing their full staffs back to the office because of Delta.
Yeah, that's absolutely true. And we also know, even in that Deutsche Bank survey, we know that employees have called for more flexibility and the option to work from home a couple of times a week. So the question is, and many are asking, if Wall Street was able to ink record numbers while working from home, what benefit does it bring them to come back in the office? There's certainly a divergence by age, by function, and by proximity to the office. This idea of commuting is something that is frustrating a lot of employees. Obviously, we've had some natural disasters lately as well that have made it difficult for people to come in more recent times. Though we are seeing some employers, I think of, for example, Schoenfeld, which is a big hedge fund in the U.S., which has created offices in the suburbs, more offices, so that employees can go to a workspace that is easier for them in terms of commute and in terms of lifestyle.
You know, Sonali, honestly, if you're taking your helicopter to one of your Hamptons houses to work 3 or 4 days a week, I think you're going to be fine. Let me ask you about some of the moves that we're seeing. CITI hiring JPMORGAN'S, TRUESDALE, and some more tech execs, and then we saw JP Morgan is buying Volkswagen's payment system. So banks are really starting to embrace the fintech and make some hires and make some acquisitions on that end.
Yeah, it's interesting that Citigroup hire is less about fintech and more about technology investment banking, which we know every industry now needs technology expertise to transform. Think about Ford and its hire just yesterday. So that's what the Citigroup hire is about. But that point on fintech is absolutely absolutely correct. You're seeing the market caps of some of these major fintech firms really start to catch up. Wall Street has taken notice. We have seen the firms, JPMorgan, Goldman Sachs, be very friendly to the fintech community, hire a lot of high-level technology talent, but this all comes together at the end, Matt. Lifestyle, pay, opportunity, the prospects of the firm. What will attract the best technology talent at the end of the day in order to make these firms extraordinarily competitive? At a time where, and we don't talk about it nearly enough, these banks are trying to do a wholesale automation of many businesses. You could think fixed income trading, for example. That has been a little behind in the last few years.
All right, Bloomberg Sonali Bosick, thank you so much. And I do want to get back to the markets now and take a look at some stocks moving in pre-market trading here in the U.S. And your big mover to the upside is Cadman, which is a U.S. biotech company. It makes a treatment for transplant, a transplant drug. It is up 75.6% in early hours after Sanofi agreed to buy the company for $1.9 billion. That's about a 79% premium to yesterday's closing price. So that's why you're seeing the outsized move to the upside. One move to the downside, though, to note is Coty Beauty. It is after it announced a secondary pricing of a secondary offering at $8.53 a share. It's trading at $8.64 a share this morning, down by about 7% or so. And one final mover to the downside is WePath, of course, the software company. It reported after the bell last night, and its revenue guidance missed some analyst expectations. Plus, an analyst over at Barclays says its annual recurring revenue may pale in comparison to some of its higher growth peers. So that stock is down about 7.1% before the bell, Francine.
Some of the movers that we're watching out for. Kailey, thank you. Coming up this hour, we'll talk about treasuries. We'll talk about inflation, of course, economic growth with Andrew Sheets, Morgan Stanley Chief Cross-Asset Strategist. We'll talk to him about cutting also the recommendation on U.S. equities to underweight. This is Bloomberg.
One way or another, we have to move more to an environment of equal opportunity, hopefully to produce greater productivity through equal opportunity, but also to reduce that wealth gap. That's opportunity gap and wealth gap thing, and that redistribution is in the swing, and that will happen.
That was Ray Dalio, Bridgewater Associates co-chairman and co-CIO. He spoke with Bloomberg's Haslinda Amin on the opportunities in China. Joining us now is Damian Sassower, Bloomberg Intelligence Chief Emerging Market Credit Strategist. And Damian, he basically said you have to be in China, which runs counter to what we heard from George Soros earlier this week, which says it's a tragedy to be pouring billions into China. Who's right?
Well, I mean, the verdict is still out, Kelly, but for me, I think you can't ignore China. I mean, the economy is, going to be the largest in the next 10, 15 years, if you kind of believe where the forecasts are headed. But for me, it's really about China government bonds. I mean, with yields, positive, real yields positive relative to other developed markets like Japan, Europe, and the U.S. I mean, that's just one area where you can clip coupon, you can get carry, you can create a ballast for your portfolio. And I think that's what BlackRock is really referring to. Obviously, there are opportunities on the ground. Obviously, there are opportunities in equities. But for me, I think it's more about the bond market. And as we all know, there's some overhang in the China dollar bond market right now due to Evergrande, which is grabbing a lot of attention.
Well, I'm glad you brought that up because Evergrande got its second downgrade in 2 days. Fitch saying probable default, got to downgrade it. What happens if Evergrande does default?
Well, obviously, it's going to be very bad for the property sector and by default, very bad for the banking sector in China, right? Because, I mean, look, what Evergrande bonds were used for is collateral to basically lend against or borrow against, rather. And so when the CCIC, which is the big rating agency in China, which actually matters more to Evergrande than Fitch and Moody's, maybe not to the dollar bondholders, but to the company itself, $300 billion of liabilities, call it $40 billion due over the next 12 months. A default is going to trigger a lot of pain in the sector. And we're already seeing that in Guangzhou, Agile, Kesa, and a lot of the other property managers in China whose dollar bonds are trading weaker off the back of this.
Damian, good morning from London. So we saw actually BlackRock going back, opening this fund. I think we had 111,000 investors wanting to get in China. Is a bigger concern that you have financial companies, in joint ventures or trying to go it alone in China, and then the Chinese authorities 2-3 years from now, go back and say, actually, I want to nationalize part of your company?
Francine, transition and volatility is nothing new to emerging market investors, right? I mean, and typically emerging market investors such as myself will look to take advantage of these, valuation discounts, these dislocations, these opportunities that are created by regulatory and political risk. And this is no different in my mind. So yes, I do believe that, Ray Dalio and Larry Fink, you can't ignore China. You can't ignore the opportunity, especially when valuations are so rich in developed markets and everywhere else in the world. I mean, there's been a lot of news about S&P forward, EPS trading at all-time highs, what that's doing to forward PE multiples 20 plus. And, if you're looking for a bit of a discount, you're looking to come into the market today, China is obviously one place that a lot of investors are just going to have to look at.
What do you think about the George Soros view? You wrote an op-ed in the Wall Street Journal saying that BlackRock is making a tragic mistake here and on the wrong side of, a life and death decision.
George Soros, look, I mean, I'm a phenomenal investor, broke the Bank of England, but a bit of a firebrand here. I mean, look, I read that op-ed piece in the Wall Street Journal. I think, for me, it's not that BlackRock is recommending that investors blindly plow billions of dollars into China. I think, what's realistic to say is, listen, if you're, again, trying to diversify your portfolio or create a ballast for your portfolio by investing in, other fixed income instruments, well, China offers all of that. And so I'm not at all defending China. I still think there's more pain ahead, Matt, but it's definitely something that you really can't ignore in this environment.
Cannot ignore it. Damien, thank you. Damien Sassower, there, Bloomberg Intelligence Chief Emerging Market Credit Strategist. Now we'll have plenty more, of course, on emerging markets, on China shortly. This is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get straight to the Bloomberg. First word news, and in the UK today, Parliament is expected to vote on Prime Minister Johnson's call for $17 billion in new taxes on workers and companies. Now they will go towards paying for improved social care. Well, Johnson's Conservative Party is traditionally against higher taxes, but the new revenue will, of course, help trim budget deficits bloated by the pandemic. Now, China has moved to complete its purge of Hong Kong's election system. New rules make it all but impossible for opposition lawmakers to return to the city's legislature. Now, in the last 10 months, over 300 elected legislators and district councillors from pro-democracy groups have resigned or been removed from office. BlackRock has raised $1 billion for its first China mutual fund. The world's largest asset manager closed fundraising ahead of its September 10th deadline, short of its goal. That's so it could start investing earlier. Well, billionaire George Soros has called the BlackRock investment a tragic mistake that could hurt clients and U.S. security interests. And what was assumed to be Apple's next big thing is suddenly in doubt. Now, the company's top automotive executive, Doug Field, has left to become Ford's chief advanced technology officer. Now, Apple has been developing a self-driving car. Field is the fourth executive leading the way to step away in the unit's 7-year history. I love this story. And Matt Miller, you're fresh from the auto, of course, the auto forum over in Munich. I don't know how close we are to driverless cars, but it's actually amazing that someone is leaving Apple to go to Ford, where, a lot of people say they're actually quite behind in terms of driverless cars.
Well, Ford seems to be doing pretty well in terms of driverless cars. I expect them to have a product out there, that could drive itself already, but it won't be legal for maybe a couple of years. Driverless cars are definitely here. The question is, when can you put them into traffic? And that's going to take a little while in terms of regulation. The Doug Field story, I think, is really interesting because he started out at Ford, and then he went to Silicon Valley, to Tesla, and to Apple, and now he's back at Ford. So it's a pretty cool way of Jim Farley, the CEO of Ford, to bring back tech and Silicon Valley people, which, to be honest, Ford and Bill Ford have been working on for quite a long time.
Well, and Matt, this brings me back to the Qualcomm interview you did yesterday morning with the CEO at the auto show in Munich. And he said car companies now have to be technology companies. And this is kind of case in point. But there's also the question of not just where this leaves Ford, but where this leaves Apple, because it's the Apple car that we've known about for many years now, but we don't hear that much about.
To me, that's the biggest question, because, of course, car companies are now technology companies. They all want to be an iPhone that you drive around in. The question is, does Apple now ever make an iPhone you can drive around in, or are those ambitions dead? Yeah.
So, Matt, is there a natural fit for Apple? So what Apple would do the systems and their Ferraris that you're driving around?
Is there a fit for Apple? I mean, I use Apple in my car, but I think car makers want to get around them and get that revenue for themselves.
Yeah. All right, we'll talk a lot more about this throughout the day. Coming up next, Andrew Sheets, Morgan Stanley Chief Cross-Asset Strategist, will talk about that bold Morgan Stanley call on U.S. and global equities. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Matt, the focus firmly, of course, on economic prospects. And once again, investors are split. Some saying valuations are cheap. The other ones actually saying that valuations at the moment look a little bit high, which is why we're probably seeing a bit of pressure on some of these stocks today.
Yeah, absolutely. I think it depends where you look. Our Michael Marcussen in London is writing in the Taking Stock column that he thinks valuations are really cheap in energy and commodities. Not just that he thinks that they are, he's actually showing us that they are just about half of the forward PEs that you see on the broader Stocks 600. And the stocks haven't done nearly as well. So for some reason, energy and commodities just not keeping up with the overall market, Francine.
Yeah, and Kailey, this is all playing out in the markets today.
It is, Francine. In the European session, you do have the stock 600 lower by more than 1%. Pretty much every single industry group is down, including the ones Matt was just talking about. You have energy, basic resources. A lot of those more cyclical sectors are actually the ones that are underperforming. The biggest underperformer is actually the autos and parts index. But as a whole, the index right now is down 1.05%. And here in the U.S., it was the cyclicals that were under the most pressure yesterday, even though big tech companies were a little bit more resilient. You actually had the 90 FANG Plus index hitting a record high. But this morning, even NASDAQ 100 futures cannot resist the selling pressure we are seeing, though they are off session lows. We're down about 0.1% at the moment. You are seeing a bid coming into the bond market. The 10-year yield down a little more than 2 basis points. We're sitting just south of 135. And then have to point to Bitcoin as well, also off of session lows, but down another 1.5% today after falling about 10% yesterday. That El Salvador unleashing the cryptocurrency as legal tender turned into a bit of a sell the fact event. Now, with that move lower in Bitcoin, you are seeing some crypto-related equities under pressure in pre-market trading. Marathon Digital, Bit Digital, Riot Blockchain, each down in the ballpark of 2 to 3%, and Coinbase down 2% as well, although part of that also has to do with the SEC issuing a Wells notice over its lend product, so we'll have to keep an eye on that story. But back to the equity market more broadly, Morgan Stanley is cutting its recommendation on U.S. equities to underweight, citing outsized risk to growth. Bloomberg's Ritika Gupta has more. Ritika.
Yeah, Kailey, Morgan Stanley cutting U.S. equities to underweight and global equities to neutral. Instead, they're saying they prefer Japanese and European equities. And it really comes at a time when there is a lot of concern about lofty or extreme valuations over in the U.S. You can see this by this chart here. The S&P 500, this orange line, and you can see it's trading at a big premium here to global equities, this white line on a year-to-date basis. Now, there's a few reasons here that they're citing for it. One, of course, the surge of the Delta variant, but they also point to this interesting dynamic here where we have high expectations of inflation but low yields at a time we have historically poor seasonality, and I quote there from Andrew Sheets' note. And they're not alone here. They have the likes of Credit Suisse, Citigroup sounding the alarm on U.S. equities. Citigroup saying that any minor correction could be exacerbated, amplified, because the extent of bullish plays that we have here in the market. And Credit Suisse also concerned about those lofty or extreme valuations, and they're also pointing to increased risks of regulation on the horizon as well. Francine.
Ritika, thank you so much, Ritika Gupta, there with the very latest for Morgan Stanley. So joining us now is Andrew Sheets, Chief Cross-Assets analyst at Morgan Stanley. Andrew, making all of the chatter, of course, on the markets jazz. What exactly are you worried about in terms of valuations?
Well, thanks. Good morning, Francine. So I think markets are in a tough place, especially the U.S. market is in a tough place over the next 60 days. I think you have a period where we think the growth data in the U.S. is going to look quite weak in September. a lot of that weakness might actually be a little bit in the rearview mirror, but the weak data will get reported in September at a time when you have heightened risks from the Delta variant, schools reopening, et cetera. At the same time, we think we're in a situation where the Fed's going to sound a little bit more hawkish than the market expects when they meet on September 22nd. We think rates will ultimately move somewhat higher. And so I think the market's in a tough place. If the data does stay somewhat soft, then earnings revisions need to come down. The market's valuations just haven't adjusted like other parts of the market have.
Yeah.
If the growth data is fine, then yields need to go up, and we think that has an outsized negative impact on the S&P.
Andrew, so how much more cautious did you turn since we started really talking about tapering from the Fed?
Well, this, ironically, I don't think is much about tapering, even though I think that's where a lot of the market focus is. I think tapering may be the issue that's best flagged by the market. I think our concern is specifically around that the Fed will potentially point to a faster pace of rate hikes when they unveil the 2024 dots at the September 22nd meeting. It's also about this window of weaker seasonality, of heavier supply in both the bond market and the equity markets, which we think could undermine some of the technical position in the market that's been so strong. So I think those are both reasons that we make this change now rather than at another time.
In terms of the central bank here, Andrew, I keep getting the feeling no one doesn't have it together as much as the ECB. Am I off base on that?
No, I think you're very much on base. And I do think that when we think about the global picture, there are really big, serious divergences between policy in the ECB and the Bank of Japan versus what we'll get from the Fed. Inflation in these areas is just very, very different, not just today, but over the last 5 or 10 years. And so there was really, I think, a significant, almost unprecedented case for central bank divergence, for the ECB and the Bank of Japan to sound much more dovish over a much longer period of time. And those are factors that we think both will weaken those currencies versus the dollar, but also in a bigger picture sense, provide some support for those equity markets relative to the US and emerging markets.
Is it going to be easier or more difficult for the ECB to be this dovish after September 26th, after a new German government?
Well, we think that they'll still have a strong case to remain dovish because they've missed their inflation target for so long, and they're moving to this new symmetrical inflation target, which should be even easier to hit or easier to justify staying dovish for longer. So we'll see what a new German government brings. If it does bring more fiscal stimulus, then maybe that would change the calculus a little bit, although I think more stimulus would be seen as probably a good thing for the region's equity market overall. So bottom line, we still think that optionality is there.
So Andrew, since you mentioned stimulus, talking about it here in the U.S., there's a major question on how much long-term economic spending we're actually going to get. Joe Manchin doesn't want $3.5 trillion in social spending, maybe more like $1.5 trillion. Plus you have the tax factor in all of that. What is and is not priced in by this market?
Well, Kailey, that's a great question, because I think this is another kind of binary event that the markets are facing as they head into September and October in a binary way that could be unhelpful. So our base case remains that you do end up getting a quite large fiscal package. Maybe it comes down into the high twos. Maybe that's seen as enough of a compromise to get Senator Manchin and Senator Sinema on board. But it's still a pretty significant level of stimulus by historical standards. At the same time, the way that the legislation is set up is that if you're not able to get the reconciliation package through, then you probably don't get the compromise bipartisan infrastructure framework through, and then you get a big disappointment from our market standpoint. So again, I think something that increases some of these kind of binary events for the market.
Well, talking about that disappointment, I was talking to Peter Cheer of Academy Securities about this yesterday, and he said if the fiscal spending doesn't actually materialize, you could see 10-year yields here in the U.S. drop to 1% way sooner than they would reach 2%. What do you think the trajectory is in terms of the bond market?
Well, we do think yields will head higher. Now, part of that is we don't think the stimulus will fail. We think it will pass. We think ultimately a compromise among the Democrats will be reached. And then also we think that if you look at the pace of rate hikes, and I think this is very important, in September 22nd, the Fed will for the first time unveil where they see their dots for 2024, which will represent a full year of hiking. So it will give us, I think, a very explicit picture of what a full year pace of hiking the Fed has in mind. At the moment, the market is thinking the Fed will approach that very slowly, but the Fed is going to be lifting off well into an economic recovery at a very low unemployment rate. So we think it's that's actually potentially a catalyst to push yields higher as much as the fiscal stimulus is also.
Andrew, in terms of valuations, you can talk Bitcoin, gold, anything at all. What do you think is the most, mispriced asset out there?
Gosh, that's a good question. So we think real yields are very mispriced. Those are exceptionally low by any historical standard. I think they also still reflect more of a secular stagnation type of market that we had over the prior 10 years than the environment that we're in now. So I think that's probably at a big picture sense the thing that is most extreme and most kind of disconnected from our macro standpoint. It's not as overvalued, but if we believe that real yields are heading higher, which our rate strategists do, if we believe the dollar is also going stronger, which we do, then that should be a negative for gold. And so we have a cautious position on the gold price.
All right, Andrew, thanks so much for the insight. Andrew Sheetzer, Chief Cross-Asset Strategist at Morgan Stanley. Now, coming up, Ford goes to Silicon Valley. More on the car maker's new hire. That's coming up next, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, FanDuel President and Interim CEO, Amy Howe. This is Bloomberg.
We have a clear roadmap. 2022 will be the last year of a firework of combustion engines only. And then in 23 and 24, we are going to hybridize all our lineup. It's not only about Europe, so we have to be prepared to be compliant worldwide. So it's useless to have, let's say, an exemption and everybody's doing thumbs down. We have to work with what the legislator is telling us.
That was Lamborghini CEO Stefan Winkelmann at the Munich Motor Show talking to me about why it doesn't matter if the Italians push for exemptions at the EU level. They need them either worldwide or not at all. The competition for hybrid cars and electric vehicles really heating up, blurring the lines between the auto industry and the tech industries. That's as Ford hires the head of Apple's car project to compete with Tesla and other EV makers. For more, Bloomberg's Craig Trudell joins us to talk about this. I think it's more of a hopeful thing, Craig. The car makers really want to be tech companies, and yes, they have a lot of chipsets in their product, but we're not yet to the point where we're driving around in iPhones, which is, clearly their end goal, right?
Yeah, absolutely. I think everyone pays a lot of attention to the fact that what Tesla has brought to the industry is electrification. But I think a sort of overlooked aspect of what Elon Musk has done and what the industry has struggled so mightily to sort of catch up to is just the idea that he turned the car into more of an iPhone-like device, and that and not just a big old screen that you could operate, but also a car that had over-the-air software updates and sort of got better as you owned it. I think this is something that the car industry sort of saw for what it was, but has had real trouble replicating it. And Ford's hiring of Doug Field away from Apple really could be a watershed moment. I think is the description that Jim Farley used last night to describe sort of what the implications of this could be.
Those are the implications for Ford, Craig, but what about the implications for Apple? What happens to the Apple car now?
It really throws the Apple car project into a sort of state of disarray. I think Doug Field was just widely regarded within the industry as a really talented engineer. He did a lot of good things at Tesla and sort of had a falling out with Elon Musk when they were really struggling on the production side with the Model 3, but he's an engineer with a very impressive resume. and did 2 stints with Apple, and has other very notable bits of experience in his history. And he also started at Ford almost 30 years ago, so it's kind of a coming home moment for him. And this is a CEO that he's working for, in Jim Farley, who himself has a long arc in terms of his history with Ford. His grandfather actually worked for the company in a factory that built Model Ts.
So, Craig, I mean, that's an amazing backstory. Craig, so what does it mean for Apple's car? Is it going to be delayed? I mean, we don't know much about it, but it's meant to be the next big thing for Apple.
Yeah, I think it's a project that's been shrouded in secrecy, and there were some, there was a lot of speculation, particularly early this year, that things were ramping back up. But I think it was a case of, conversations that were taking place between Apple and some companies, both car makers and major suppliers in the industry. But we're still in a place where we really don't have a lot of sort of hard and fast details as to what exactly Apple's aim is. And Tim Cook has said in the past few months, sort of alluded to the idea that, they may not decide to go forward with a car project. He's alluded to the idea that, they have done a lot of work on various projects and sort of decided not to go forward with them. So, we don't know at this point whether this sort of marks the end for Apple, whether it's a setback that, pushes back their entry into the industry, but it's definitely a big loss.
Yeah, I mean, I just can't see where they go with an Apple car. Do they make a fun little city car? Is it a sexy, luxury GT? There's so many options, and it doesn't seem to make sense to do all of them or only pick one. In terms of companies like Ford or Volkswagen, they can make the entire palette, and they are. Fran keeps asking me about self-driving cars, Craig, and Herbert Diess was telling me a couple days ago he thinks it's just a couple of years until we see robo-taxis going around, cities. When are they going to be on the road?
I think we will start to see sort of limited deployments here in Europe. I think we've seen some of those in the U.S. and I think largely for regulatory reasons we have not seen as much activity here. But my expectation would be that we may see play out in Europe much what we've seen in the U.S., where there will be a hype cycle, a lot of excitement sort of being stoked about self-driving cars coming to streets. But you look at what's happened with Waymo, a company that's widely regarded as being out front here. They really are sort of very contained in terms of what they're doing with their driverless robo-taxis, operating just in a suburb of Phoenix. And, we're talking about years now that they've been working on trying to take the driver out of the human out of the driver's seat. This is really, really difficult. And VW's self-driving partner said at the show that this is a multi-generational project. It's going to take a long time.
Craig, thanks so much for all of the insight. Craig Trudell there, who is in charge of our autos coverage. Now, coming up next, part of our interview with Reid Hoffman, Greylock partner and LinkedIn co-founder. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now, is the boom in the venture capital market leading to a bubble? Well, David Rubenstein sat down with Reid Hoffman, Greylock partner and LinkedIn co-founder, on the latest episode of Peer-to-Peer Conversations.
Well, you're always worried about the markets getting overinflated. Amount of stimulus, everything else is part of making this happen. And so I do think that there is some risk within the general market of this. Now, that being said, technology is accelerating the transformation of all industries. There's what artificial intelligence can do to all industries. There's obviously, that's the leading edge of software. There's things happening with AR and VR. There's things happening with crypto and fintech. And so all of this area, I think, is very much accelerating in the future. And so I think that's part of the reason why the venture industry has been so good, is because technology is important in redefining many key industries.
Now, some people would say that the technology world in the United States is dominated by just a limited number of companies.
Google, Facebook, Apple, Netflix, Microsoft. I'm sure you're familiar with all this. Do you think that the United States is dominated by too few technology companies, and something should be done to kind of weaken their power, or do you think it's okay as it is?
Well, what I think that we're heading to is we're going from 5 massive tech companies to 10. I think we're already naturally heading in that direction. You can see it with things like Netflix and Salesforce and all of these other companies, which are continuing to also grow in strength and create a breadth of additional global, very strong technology companies. And as perspective as an investor, when you go around and you ask kind of what all the kind of the venture capitalists, they're like, no, we're having more and more startups, more and more ability to create amazing new tech companies. So like, if anything, I think we're already naturally on that trajectory.
Do you think that large Chinese technology companies, Alibaba, Tencent, Baidu, ByteDance, and so forth, can have their technology become very dominant or important in the United States and around the world? And are we in a world now where we're competing with Chinese technology companies for market share outside of the United States and China?
So I think we're already in that world. I think that if you look at kind of things that Alibaba is doing in terms of spreading the Alipay and everything else into South America, into Africa, I think that the notion of the technological platforms of the future are in deep, there's a fast moving competition between companies in Silicon Valley and companies in China. And I think that's part of which systems will be the systems that the world operates in is, I think, in deep competition. And that being said, I think we're already seeing Chinese platform companies beginning to make strong headroads into the U.S. ByteDance and TikTok is an obvious one, but I think you already see it in also like drone manufacturer and DJI. There's a whole bunch that are already getting massive global relevance, and you can see it already.
There you go, the Greylock partner and LinkedIn co-founder Reid Hoffman. Catch the full episode on the David Rubenstein Show Peer-to-Peer Conversations. That's tonight at 9 p.m. in New York. Now look at what else we're watching today. I know you're looking at some of the automobiles, and I'm also looking at job openings data, and then we're looking at the UK, Matt.
Wait, I thought I was looking at the job openings data.
You are. It's the royal.
I'm looking at JOLTS. I mean, I'm always looking at automobiles. You're right, actually. I got some work to do on my car today, but I am definitely looking at the jobs data. The JOLTS job openings data come out later, and I think it's some of the most fascinating labor data that we get. So pay attention. That comes out at 4 o'clock my time, so 10 o'clock yours.
Yeah, and then before that, I'm also looking at UK taxes going up. Now, more Bloomberg surveillance coming up ahead. We'll hear from the Egyptian Minister of Foreign Affairs, amongst others. This is Bloomberg.